Good afternoon, and thanks for joining us for today's webinar, SOX Implementation. I'm Elaine Nissley, Principal and Leader of the firm's Internal Audit and Management Consulting practice. I've been doing Sarbanes-Oxley implementation since 2005. And we are celebrating the 20-year anniversary of Sarbanes-Oxley this year. And joining me today is Michael Murray. He's a senior consultant with McKonly Asbury.
Good afternoon, everyone. I'm Mike Murray. I got my professional start as a human intelligence collector in both the U.S. Army and Defense Intelligence Agency. I made a mid-career shift to IT after getting a bachelor's degree in digital forensics. Prior to coming on board with McKonly Asbury, I gained experience as a business manager for a small masonry company, as well as a local IT administrator for the James Smucker Company.
Thank you, Michael. I've been with McKonly Asbury since 2005, and I've enjoyed working with many of our clients on Sarbanes-Oxley implementations. And for those of you who know McKonly Asbury, it's an accounting and business advisory services firm with offices in Camp Hill, Lancaster, and Bloomsburg, Pennsylvania. We provide a range of services to organizations across a variety of industries, as you can see on the screen. And we encourage you to visit our website to learn more. If you've joined us on past webinars, welcome back. If you haven't, our monthly webinars feature various business topics to keep you updated on what's going on around us. Be sure to check out our website to catch past presentations, as well as current information through our blog. If you have any questions for today, during today's presentation, please submit them through the built-in question function in the webinar control panel, and we will do our best to answer them during or after the webinar. For those of you that are looking to obtain CPE credit for today's webinar, please keep in mind that there will be 3 polling questions throughout today's presentation. You'll need to answer all 3 of those questions to get your certificate by email a few weeks after the webinar. Okay, we are at our first polling question. Okay. So what is the status of your organization's SOX implementation? We're looking for some feedback to help us as we go through our presentation so we understand where the audience is coming from. Okay, so we have about 5 more seconds here for you to make a decision and to answer the polling question. Okay, so we have the majority of people in the other category. So that is a very interesting response. We do have several people that have implemented Sarbanes-Oxley, and about 18% that are not thinking about an IPO, and no one who's thinking about an IPO. Well, welcome anyway today, and we will do our best to give you a good background on Sarbanes-Oxley here. Let me see. Okay. So our goal today is to provide at least one aha moment for each of you today. And we encourage you to record your aha moments and share at least one via the session chat if you feel comfortable doing that. But our session today is going to cover just a little bit on the background of SOX, the key sections of SOX, talk about SOX implementation, talk about SOX and the COSO 2013 internal control framework. And we'll discuss some rabbit holes to avoid as you do your SOX implementation. And now I'm going to turn it over to Michael, who's going to go through understanding the background of SOX.
Thanks, Elaine. I'm going to speak a little bit about the backgrounds of the Sarbanes-Oxley Act of 2002, what triggered it, what it means, and who it affects. The bill was sponsored by the Democratic Senator Paul Sarbanes of Maryland. He is the guy on the left, and Republican Representative Michael Oxley of Ohio, the guy on the right. It was signed into law on July 30th, 2002 by President George W. Bush, who called it, quote, the most far-reaching reforms of American business practices since the time of Franklin D. Roosevelt. The era of low standards and false profits is over. No boardroom in America is above or beyond the law, end quote. So what was the spark that brought about such sweeping change? In a few words, Enron, Tyco International, Adelphia, Peregrine Systems, and WorldCom all had major accounting scandals which cost investors billions of dollars collectively and impacted the world economy in a big way. That means that people who had never invested a dime in their lives were also on the hook in some way or another through increased cost of goods and services. The fallout from the bankruptcy proceedings, congressional hearings, and other interviews with executives and board members brought to light some accounting practices that ranged from questionable to outright fraudulent. Many of the excuses given by company leadership in those venues were centered around the tropes of I didn't know or I didn't intend to fill in the blank. One of the few things that was clear about the messes left behind was that these scandals were a result of a self-policing system where companies were more or less taken at their word that they had measures in place and that the numbers reported to the public were accurate. Prior to SOX, there were internal control frameworks such as COSO Internal Control Integrated Framework, or ICIF, available for organizations to use at their discretion. The SOX Act of 2002 required the use of an internal control framework. COSO is on the list of recommended internal control frameworks to use as a basis for the assessments of internal controls over financial reporting. Later in this session, Elaine will go over the COSO framework and relate it to the implementation of SOX. Since the primary focus of the SOX Act is protecting stakeholders from fraud and negligence, you might be tempted to think that it only applies to publicly traded companies, when in fact there are provisions that apply to private companies as well. I'm going to give a few examples here. One is criminal liability for document destruction as it relates to destroying, altering, or falsifying records related to a federal agency investigation. That can catch you up to 20 years imprisonment, fines, or both. There is liability for retaliation against whistleblowers. That makes it a crime to knowingly retaliate against any person who provides accurate information to law enforcement regarding the commission of a federal offense. There are increased penalties for white-collar crime, securities law liabilities not dischargeable. That means that Sarbanes-Oxley makes state and federal liabilities for violations of securities laws not dischargeable in bankruptcy. This applies to liabilities for failure to register securities as well as anti-fraud violations. It addresses securities fraud, which extends the statute of limitations for investors to file a private securities action for securities frauds to 2 years after the discovery of the facts and 5 years after the occurrence of the alleged violation. In addition to those rules, there are additional provisions which apply to private companies. One being a public company purchasing a private company becomes responsible for Sarbanes-Oxley compliance with respect to the acquired company, including certification of consolidated financial statements. A private company's financials, sophistication, and internal controls may be material issues in a public company's decision about a potential acquisition. Many provisions of Sarbanes-Oxley expressly apply to private companies that have registered debt securities. So I hope that gives an idea of where the SOX Act comes from and where it may apply to your company. Coming up next, Elaine will go through the specific sections of the SOX Act and elaborate on the details contained within.
Yes, many people, when they think of Sarbanes-Oxley, they think of the requirement for internal control over financial reporting and the assessment by management and by the financial statement auditors. And that, of course, is the most time-consuming, the costliest section. But there are other sections and other compliance issues that the organization needs to consider during their implementation of SOX. The Sarbanes-Oxley Act of 2002 was a major regulation, and the cost of compliance has far exceeded the initial estimates. Much of this diligence on behalf of companies was driven by the heavy penalties, including fines and major jail time that could be imposed for non-compliance. I have experienced many instances where executives, especially the CEO and CFO, have imposed upon their employees the need for compliance by indicating that they are depending upon their employees to keep them out of jail and to avoid personal fines. Threatening severe personal penalties has been very successful in getting the CEO and CFO to loosen their purse strings. That being said, it is still important to be diligent in implementing SOX in the most cost-effective manner. We hope that our highlights today will provide at least one aha moment for each of you, which you can take away from this presentation. The first section I want to highlight is Section 302. This section requires the CEO and CFO to certify the financial reports on a quarterly basis. A common SOX control related to Section 302 is for managers with key ICFR accountability to provide a quarterly certification to the audit committee. The objective is to impress upon management the reliance that the CEO and CFO are placing on their compliance with ICFR. The importance of financial statement auditor is highlighted in Section 401 because the financial statements need to comply with GAAP. In addition, the CEO and CFO, in combination with the financial statement auditors, need to review any off-balance sheet transactions and verify that any off-balance sheet transactions are included in the financial statements. Off-balance sheet special purpose vehicles, SPVs, allow a company to move assets and liabilities off a company's balance sheet while potentially continuing to use those assets. If you could transfer an asset off your balance sheet to a separate entity for more than the value it's sitting on your books, then you can recognize that difference as a gain in earnings. Yes, we all love increased earnings, right? Especially when we're dealing on the stock exchange. Andrew Fastow, once the CFO to Enron, is the off-balance sheet vehicle legend. At Enron, he created 3,000 separate off-balance sheet corporate entities. Fastow used the SPVs for a variety of purposes, including collateralizing debt and moving impaired assets. In simple terms, he created a web so complex that it was impossible to discern the true liability position of Enron and enabled him to inflate earnings. Fastow also invested his own money in some of the SPVs and took out $60 million in fees. So we have Andrew Fastow to thank for Section 401 of SOX. Section 409 highlights the importance of having a disclosure committee who has accountability to work with the financial statement auditors to make sure that all disclosures will be understandable by the average investor, including any necessary trend and qualitative information to support and make clear the disclosure information. As the CEO and CFO review and sign off on the financial statements, they need to pay attention to the completeness of disclosures and make sure they include any material changes in the organization's financial condition. The SEC is always looking for new ways to provide information to investors. One that is currently happening is the emphasis on environmental sustainability, social accountability, and governance, commonly called ESG. The SEC will soon be requiring disclosures on what your organization is doing about climate-related risk. It is important that the CEO and CFO stay current on SEC disclosure requirements and make sure that there are controls in place to provide reliable information to support the disclosures. In Section 802, the CEO and CFO are not the only people being held accountable for the financial statements. Any accountant or auditor, both public and internal, must maintain their records for at least 5 years. The other thing to keep in mind is that these records may be subject to legal investigation. Any discrepancy between the supporting records and the financial statements may come out of this investigation and may open up the avenue for allegations of fraud or cover-up. In support of Section 806, the organization should have controls to provide avenues for anonymous reporting of suspected wrongdoings. Direct reporting of suspected wrongdoings to the audit committee is required. Frequently, the audit committee will receive all of the reports that come through the hotline so that there is no question of their oversight. Not only should the organization have ways for anonymous reporting, they also need to have strong policies and controls to make sure that there is no retaliation against individuals who suspect wrongdoing. The organization needs to build and encourage an environment of openness and trust. I have performed various business ethic reviews for organizations, and senior management is always surprised by some of the findings. There are always several findings that are important enough for management to address. So do you really know what is happening in the trenches of your organization? In my early days during SOX implementation for organizations, I always requested that the CEO address the key control owners to impress upon them the importance of SOX compliance. Frequently, the CEO told his management staff some variation of, "I do not like to wear stripes or orange, and I am depending upon you to make sure that does not happen." That Section 902 remains in effect, and that is still a true risk for all CEOs and CFOs. Section 906 requires the CEO and CFO to provide written certifications and imposes further penalties for false or misleading certification. So this is also a risk to the organization as a whole. Could your organization survive the scandal and financial losses if the CEO and CFO were indicted? I have left Section 404 to the end. This is the section that causes the majority of the expense and pain when preparing for SOX compliance, such as preparing for an IPO or sale to a publicly traded company. The assessment of internal controls over financial reporting is not a task that can just be absorbed into day-to-day operations. The implementation of SOX requires careful planning and dedicated resources. The initial implementation is typically a very heavy lift and requires outside knowledgeable resources for a successful implementation. Section 404 is all about the system of internal controls over the financial reporting, which I will call ICFR going forward. It is an opinion of the effectiveness of ICFR as for the financial year. That means you can find weaknesses in ICFR throughout the year, but they must be remediated in time to test a full sample of controls performed for the financial year for which the attestation applies. Industry standard for a monthly control is to test 3 controls. So that means the control must be operating effectively for the last 3 instances that monthly control was performed. It also means that the financial statement auditors will most likely perform additional substantive procedures over the areas since they could not rely upon the control for the entire year. So not only does having a control that fails and is not working at the end of the year an issue, but having controls that have failed throughout the year, even though they're remediated, can still add additional cost to the financial statement audit work. Okay, I am now going to hand off to Michael to talk about implementing SOX. And for those of you who have the PDF file that was sent out, there's a slight difference in the sequence. And so this slide in the PDF is actually slide 37 in the deck.
So I'll
Michael.
give everyone a moment to kind of flip over to that slide. So now I will be giving a broad overview of what implementing those sections might look like in a company preparing for SOX compliance. The generally accepted, here are the steps that are generally accepted to meet that goal. That is identifying the scope, implementing controls, testing controls, identifying deficiencies, and delivering management report on controls. So we're going to start off with identifying the scope. Identifying the scope of what falls under SOX compliance can seem to be a daunting task, but using a risk-based approach, as previously mentioned, can help streamline the identification process. Internal controls must cover a wide array of items. For example, on the IT side of the house, network activity, database activity, successful and failed login activity, user activity, and quite a bit more, all need to have specific controls in place. On the financial side, using a revenue-based assessment can help determine what falls under SOX. For example, if an asset generates a given percentage of a company's revenue, whether that be 3%, 10, or 50% of the total income, then it can be subject to its own host of controls. Finally, on this point, look at what internal controls are already in place. It can be quite useful to make use of existing controls by assessing their similarity to SOX controls and asking, are they using the same standard? What would it take to merge them with SOX standards? Do you have the right people who can make that happen? From these answers, you can see the difference between what your expectation is and the true states of the company. Moving on to actually implementing the controls. Implementation of internal controls almost certainly means change. You can see the first item is management attitude, and that is to highlight its importance in the process of getting the company where it needs to be SOX compliant. Managers hungry for adaptation of new ways of doing business can frequently be infectious to the people they manage. It is quite easy to become used to routine and doing what is known and safe. which makes it all the more important to gauge how close to SOX compliance the company already is, as I stated previously. Knowing how much change will be required throughout the organization will aid in pitching compliance campaigns to the workers who will bear the brunt of the changes. It is also important for managers and decision makers in the organization to become educated in the 17 principles of the COSO framework, which Elaine will get into shortly. Individual managers will become control owners, effectively becoming the in-house experts. They will apply necessary changes to the controls in their area of responsibility. Aligning the company's existing controls with the principles laid forth in the COSO framework will begin to give you a picture of a one-to-one comparison of the controls you have in place versus what remains to be done. You can then start to implement additional controls around this familiar territory, which can help reduce the figurative whiplash of becoming a SOX compliant organization. Now that the controls have been identified and implemented, we have to figure out if they are actually working. This is when testing comes into play. Depending on the complexity of the organization, there could now be controls in place which, in order to test them, require personnel with a specialized skill or a higher degree of competency than what may be available in-house. It is important for decision makers to recognize where skill gaps exist and be willing to fill them, either by providing training to those already on board or hiring outside experts. It may be necessary to develop custom technical tests, particularly on the IT side of the house, where a unique combination of network, server, and software configurations may be used to meet control standards. Bringing in third-party experts to devise these tests can be beneficial in a number of ways. One being that you can leverage the experience of experts in the given field to design tests that are meant to test the control rather than create tests that are designed to be passed. There can be a real resistance within an organization to pursue this route due to the costs involved, which may redirect funds from other business functions or ventures. While understandable, it is worth taking stock of what it would cost to cover the same ground twice if an internal control is later found to be deficient, not to mention the potential damage to reputation, fines, and costs involved in bringing in third-party help to fix the deficiency. Testing the controls will provide a picture of what areas require remediation or further attention. Rushing to duct tape the problem areas is not necessary, as SOX does provide a reasonable amount of time for remediation of failed internal controls. Given that, it pays dividends to be rigorously honest about the nature and scale of the deficiencies. Doing so will allow management to determine what needs to be done and if there are the right people on board to fix the problems. Keeping documentation during this phase is incredibly important, not only for future reference for management, but also to create an audit trail that makes it easy to identify when a deficiency was encountered, the key personnel responsible, and what the remediation plan entails. Identifying deficiencies in controls should be seen less as a phase and more as an ongoing task to be performed by those who encounter the controls on a daily basis. With the testing complete and the deficiencies cataloged, the final report to management, the ICFR, it can't be understated that this is a report that should contain bad news which is being delivered to leadership. This is something that people typically shy away from at nearly any cost. Keep in mind the consequences of having an inaccurate report, which we covered earlier in the presentation. When it comes to the specifics on controls, the report should contain, among other things, a control identifier, identification of the control that failed, root cause of the control deficiency, a remediation plan, and remediation steps to be performed, as well as its current status. This kind of granular report to leadership may not be common throughout all organizations. However, this should be considered an opportunity for management to gain a better understanding of what is happening within the company. From here, I will be going back to slide 19, and I'm going to pass it back to Elaine, who will go over the COSO framework for implementing SOX.
I guess if I unmuted, now everybody can hear me, right? Okay. The SEC requires that the assessment of ICFR be done using a recognized internal control framework. Their examples include internal control integrated framework created by the Committee of Sponsoring Organizations of the Treadway Commission, commonly called COSO. And this is the framework that is basically industry standard in the US. But also the SEC has approved guidance on assessing control published by the Canadian Institute of Chartered Accountants, the COCO model, which is generally used in Canada. And the report published by the Institute of Chartered Accountants in England and Wales, Internal Control, Guidance for Directors on the Combined Code. This is known as the Turnbull Report, and this is commonly used in the UK. So COSO is the standard used by most US companies. COSO was updated in 2013, and so the current standard is COSO 2013. We're going to have a high-level review here of how COSO guides the identification and implementation of ICFR for SOX compliance. The COSO framework is broad and covers operations, reporting, and compliance. The SOX compliance we are concerned with only with the SOX regulatory requirements and ICFR. For an efficient SOX implementation, it is important to maintain the boundaries of your scope to only SOX compliance and ICFR. It's easy to stray into operations and compliance areas that do not impact financial reporting. We will review the COSO model, which has 5 components and 17 principles. All of the 17 principles have 4 to 6 points of focus for a total of 79, which provide further guidance on the control objectives for each of the principles. And we will discuss how COSO guides a SOX implementation. In addition to the controls over corporate operations, we will discuss the business processes and information technology controls and some of their unique requirements. I like to use this model for COSO because as the COSO SOX model. The SEC supports a risk-based approach to the implementation of SOX. The goal is to reduce the SOX compliance burden. Using an effective risk-based approach during SOX implementation is key to an efficient ongoing process. To this end, I propose this modified version. At the top, we have the controls environment, which drives your entity level controls. These controls impact the entire organization. Effective entity level controls result in lowering the risk which ICFR must mitigate. The next component is risk assessment. During the risk assessment, it is important to set the boundaries to only include the risk to the financial statement reports and SOX compliance. This is a huge win if you can accomplish effective boundary setting during your risk assessment. The final three components are control activities, information and communication, and monitoring. Controls in these areas should only include those controls required to provide reasonable assurance that ICFR objectives are achieved. So looking at the components, the first component of control environment consists of 5 principles. Principle 1 relates to the tone at the top and whether it fosters and creates an environment with integrity and high ethical standards. This is done by creating standards that are put into writing, and adherence to the standards are monitored and deviation is addressed. Principle 2 establishes a board of directors with sufficient members who are independent from management in order to provide objective oversight. SOX compliance, the Sarbanes-Oxley Act, actually requires the board to have an audit committee made up of independent members of the board. Principle 3 requires that management establishes an organizational structure that supports the achievement of objectives, including segregation of duties, especially in the area of ICFR. Principle 4 is mainly our human resources based portion of ICFR, which provides for adequate and competent staffing, policies and procedures to support expectation of competencies, and a means to enforce that expectation. So this would include things like adequate onboarding, recruiting and onboarding process, including background checks, job descriptions, performance evaluations with expectations of competencies, and also remedial action if the performance evaluation is below expectations. And this area also includes the important area of succession planning. Principle 5 provides for a structure that supports ICFR by holding individuals accountable for their ICFR responsibilities. It also takes into consideration fraud risks and reducing pressures and opportunities that result in fraud. The risk environment includes principles 6 through 9. Principle 6 applies to assessment of risk related to external financial reporting to the SEC, investors, or any other stakeholders, and the reliability of non-financial external reporting. We generally narrow these down to financial and non-financial risk related to SOX compliance. Principle 7 assesses risk to achievement of the entity's objectives, setting a boundary at those risks related to SOX compliance. Principle 8 incorporates consideration of fraud risk when assessing ICFR. And Principle 9 incorporates the consideration of risk introduced by change when assessing ICFR. In the control activities component, this is where the heavy lift is for ICFR. Principle 10 covers the business processes, internal controls, and we will cover this section in more depth a little bit later. And Principle 11 speaks to the importance of consideration of information technology's impact on ICFR. We will also cover this section in more detail later. Principle 12 covers the importance of policies and procedures for ICFR and the framework required to enforce the policies and procedures. ICFR and the assessment of ICFR should be based upon policies and procedures that document and define the ICFR. I started my career in the world of computer science. In college, I quickly learned that garbage in is garbage out. That also applies to the development, implementation, operation, and assessment of ICFR. Principle 13 captures the importance of quality during the processes of identifying, capturing, processing, and reporting of information. It also stresses that cost benefit should always be a consideration. That is, the quality of the information should be good enough, but not so good that the organization cannot afford it. Principle 14 covers the communication of ICFR and financial reports internally and to the board. This is generally accomplished by a SOX committee made up of management with major ICFR responsibilities. The SOX committee monitors the SOX implementation, ongoing assessment of ICFR, and addresses deficiencies. Also, management reports the status of ICFR and provides a financial reporting packet to the audit committee. Reporting also includes whistleblower hotlines, cybersecurity, and ESG information. Principle 15 includes a relevant and timely outbound and inbound communication with shareholders, partners, owners, regulators, customers, and financial analysts and other external parties. External whistleblower communication for anonymous reporting, it should also be made available to the public. Monitoring of the system of ICFR is important. Principle 16 requires a mix of evaluations that consider business changes and uses a baseline for continuous assessment of ICFR. It is important that evaluation of ICFR be done by individuals with sufficient knowledge to understand what is being evaluated. The ongoing evaluations are built into the ICFR, such as management review and approval of controls performed by others. Ideally, separate evaluations are completed by independent and objective auditors who meet the requirements for the financial statement auditors to rely upon their work. Principle 17 indicates that management has the accountability for assessing the control activities. So again, management owns the system of control. So even those organizations that have an internal audit department, the internal auditors do not own the controls. Management owns the controls and has accountability. They need to oversee the assessment of the control activities and report the status to senior management and the board, and report on the status of any of their corrective action plans. And again, this can be fulfilled by the SOX committee we discussed for Principle 14. So we are now going to have our second polling question. So this one, we're just asking, if you look at the 5 components of COSO, which is the most costly to implement? Control environment, risk assessment, control activities, information communication, or monitoring? Okay, we have 5 seconds left here, and we will see the results. Okay, so we have a variety across the board. And we have 22% on the controls, 16% on the risk assessment, 24% on the control activities, and 38% on the monitoring. Unfortunately, my vote is in the area of control activities, so we do not all agree. Okay. So we have looked at the 17 principles of COSO. Principle 10 and 11 are the most time-consuming and expensive. We will discuss the business process, ICFR, and information technology controls in more detail. To effectively assess these controls activities, I recommend using 2 additional standards. The standard for business processes relates to making sure we cover the financial statement assertions, and the standards for information technology, you can use COBIT, which is driven by the Information Systems Audit and Control Association. Some organizations who have a high reliance upon security will use the NIST, the National Information Security Technology Standards. So there's various IT frameworks that can be used. There's ISO frameworks as well. So control activities do go across all different types of controls. We have entity level controls, and I call these low-hanging fruit. Most of these controls are annual or quarterly controls. A good example of an annual control is a review and signing of the employee handbook with assertions related to compliance with policies and procedures for business ethics, information security, whistleblower reporting, or other relevant corporate policies. And then quarterly controls are usually board of director or board committee meeting minutes. For example, board approval of SEC financial reports and quarterly earning announcements, audit committee oversight and approval of auditors and monitoring of the whistleblower reporting, compensation committee setting executive compensation and succession planning, and the Disclosure Committee review and approval of SEC reporting disclosures. These controls are usually easy to document and test and provide a return as far as reducing corporate-wide risk. Business process controls are the most time-consuming and largest number of ICFR. Setting appropriate boundaries based upon a risk and materiality assessment is key to reducing the number of controls. In addition, management review controls play a large part as well. Usually, management review controls are monthly or weekly, which typically only requires a testing of 3 to 10 controls. Daily or multiple times per day controls can range from 25 to 40 in sample size. So there's a huge difference to the extent that you can rely upon the entity level controls in the control environment. It gives you comfort level to rely upon the management review controls and will substantially reduce the testing time of your controls, which is typically the majority of the cost and expense related to Sarbanes-Oxley, initial implementation and ongoing implementation. Another winner is automated controls. If you can rely upon the information technology general controls and one of your ICF controls is automated, then after performing a baseline test, you only need to test one of the controls. A good example is using an automated three-way match for accounts payable to automatically match the invoice authorization, purchase order approval, and the receiving of the goods or services. Financial statement insertions are an important part of the business control identification and assessment process. It is important to select sufficient key controls for each business process so that all relevant financial statement assertions are covered. There are many variations on the financial statement assertions. The following slides will cover the financial statement assertions and include some examples of controls to demonstrate how one control can cover multiple assertions. Another opportunity for more return on your investment. So starting with existence and occurrence, we'll take a quick run through the financial statements assertions, and we'll use the monthly account reconciliation and management review and approval as the key control. So the timely management review and approval of the reconciliation of a balance sheet account meets the existence assertion, and of an income statement account, it meets the occurrence assertion. The control should be designed so that the manager reviewing the reconciliation does not record the transaction or prepare the reconciliation, and the control will meet the safeguarding of assets assertion. The review control should be designed so that the control is completed and dated prior to the completion of the financial statements. If so, it is preventive control, which is stronger than a review after the financial statements are finalized, which is a detective control. Completeness, the timely management review and approval of the reconciliation meets the completeness and cutoff assertions. The timely management review and approval of a reconciliation, account reconciliation, should meet the valuation, allocation, and accuracy assertions. timely management and review and approval of an account reconciliation meets the classification assertion. And the understanding assertion is generally the disclosure committee review and approval of the disclosure. The timely management review and approval of the reconciliation can meet the rights, authorization, and obligation assertions. So as you can see, having strong management review controls is important. The thing to keep in mind is to assess if there are controls that the manager is relying upon when completing the review of the account reconciliation. Assess if any of those controls should be considered key controls. For example, when it comes to inventory accounts, there is heavy reliance upon the physical inventory accounts and adjustments. So these are generally key controls. But again, in that area, you can usually rely upon a management review control where the manager does the review and trending analysis to validate the physical inventory counts. So what are SOX IT controls? In general, SOX requirements include both business controls and SOX IT controls. On the business side, the controls are those around the accuracy of the data that feeds into financial reporting. From the IT perspective, there are IT general controls and applications controls. The goals for SOX IT controls are to ensure that the systems are accurate, complete, and free from errors, since that would impact the financial reporting. The key to defining your scope for SOX is to understand which processes and systems actually impact financial reporting. Where most get confused is in differentiating between critical IT systems and SOX IT systems. You may have a system that holds all of your customer information that is critical to the success of your organization. But if that system does not capture financial data that feeds into your financial reporting, then it's not a SOX application. It should still be well controlled, but it is not in scope for SOX testing. Okay, and now we are switching back to slide 36, and Michael's going to talk about some of the rabbit holes.
Thank you, Elaine. We're going to, like Elaine said, we're going to go over a couple of rabbit holes, that is, concepts or tasks which can needlessly cost time, effort, stress, or money. The first one we're going to talk about is using too many controls. If you look at the list upon list of controls, it's easy to feel discouraged, to say the least. While it takes some time invested up front to become familiar with controls, keep in mind that not every control applies to every company. Using a risk-based or revenue-based assessment helps clarify which controls apply and which controls you can pass on. This makes it all the more important to have experts on hand who can help navigate that early stage of SOX implementation. Having confusion on roles and responsibilities. Having clear organization with clear roles and responsibilities is important to achieve prior to beginning SOX. Skill gaps may begin to show during the implementation process, and management may be hesitant to hire additional personnel to fill those gaps. However, this increases risk that important details may be missed by personnel who are struggling to keep up with learning a new skill and filling new responsibilities. SOX compliance doesn't mean abandoning business objectives. This is another example of where management attitude toward change becomes crucial. While SOX can be expensive and burdensome, the company is getting plenty in return for those sacrifices. Proper implementation of SOX produces reliable information that business leaders can use in decision making. It produces a culture of checking the problem versus checking the box. When areas of responsibility are clearly defined, it allows managers to assign tasks more easily, and makes passing the buck on problem areas far more difficult.
Okay. Yes, we did talk about the COSO, the SOX COSO model. And again, using this model drives a top-down approach, which is much more efficient than using a lower bottoms-up approach, which generally results in more controls. And the other thing to keep in mind as you're going through your SOX implementation, it is a heavy lift for most organizations, and it's also a great risk of management seeing what they want to see. So you may want to consider having objective individuals, whether it be your internal audit department or whether you're doing peer review where an area not responsible for controls is reviewing the controls, so that you get a more unbiased view of the core controls and assessment of the controls. We are going to flip here real quickly to doing the final polling question. And then for those who want to stay around, if you want to do any Q&A, we will give you the opportunity for Q&A, but those who want to do the final polling question and sign off can do so as well. So what information presented today was most useful? The COSO framework, control activities, SOX implementation, rabbit holes, or we did not get a chance to present the aha moments. So but if you found that useful in writing down aha moments, certainly vote for that. Five seconds here. Okay, so looks like control activities is a winner, and we did have somebody who enjoyed the aha moments. So now we will, let me see if I can get back. Okay, so did we have any questions come through today? I did not see any. And did we have anybody share any aha moments? We did not. I think we are finished for the day. And thank everyone for joining us today, joining us. Okay. So thank you for joining today. And if you have any further questions regarding the presentation, please feel free to reach out to Michael or myself. A recording of today's presentation will be posted on our website and social media sites in a few days. And for those of you who requested CPE and answered the polling questions, those certificates will be sent out within the next 2 weeks. So thanks for joining us and enjoy the rest of your day.
Thank you, everyone.